All right. Hello, everybody. This is Mike Rixey again. I'm the lead options instructor for NetPicks. And I wanted to jump on, give an update on one of the trades that we talked about in our recap webinar last week. We talked about putting on a credit spread on symbol WORK. We are approaching a target level here today. So I wanted to walk you through how I plan on managing the trade. I'll also show how you can create a closing order as well if you haven't done so already. Before we get over to that chart of work, let's go ahead and take a look at this market as a whole. If we take a look at the daily chart of SPY, we hit a key point of resistance here just yesterday. We know that this market has been on an incredible ride. We've had big moves in both directions, correct? We've had a pretty big sell-off. We followed that up here over the past week or so with a pretty impressive bounce off of the lows. And take a look at where we found some resistance yesterday. We saw a bounce right up to these 20-period moving averages. Those are the solid and dotted green lines on my chart. Those are the simple and the exponential moving averages. And actually, let me see if I can I'll go ahead and take my webcam off there so we can make the chart a little bit bigger so you can see it a little bit better. So I'm talking about the 20-period moving averages here. We tested those levels almost to the penny before immediately pulling back. And we've had a pretty big sell-off. Now, the argument could be made. We had news out last night. President Trump was speaking and talked about how difficult the next few weeks were going to be with the virus continuing to spread. Bottom line is we have no control over the news. What we can look at is the technical picture, and we saw that area of resistance hit yesterday. We've seen some decent selling today. The volume, pretty darn good. Here we are with a couple hours to go in the session. We're already up over 100 million shares. We continue to see big volume on the downside. What am I expecting here? I talked about it last week. I was expecting another leg to the downside. We're starting to get that. Right, we sold off yesterday afternoon. Obviously, we can all see what's happening today. The Dow is down 850 points. The Nasdaq's down almost 300. The S&P's down almost 110. Where do we go from here? There's a couple areas of support that I will be looking at for the rest of this week and into next week. The next area of support that I'm looking at is right at 240. Now, I realize that's another almost $7 below us. In this market, you've got the volatility, you got the VIX up over 57. A $6 move, a $7 move on SPY can happen very, very quickly. It can happen in a matter of hours. So that's going to be the next area that I'm looking at on the downside. Beyond that, it would not surprise me at all if over the next week or so, we get back down and test the prior low down at 218.26. Those will be levels that I'll be watching closely on the downside. We talked about the ATR last week as well, the average true range. You can see, even though it did dip somewhat over the past week or so on that move to the upside, we saw markets start to settle down a bit intraday. We're still very active here. We still have some pretty big range in this market. And then again, with the VIX, with volatility up above 57, it continues to be a very volatile environment. What that means for us is the option prices are incredibly expensive. We continue to see that across the board. That's why last week we talked about continuing to use the vertical spread, specifically the credit spreads. Let's go over and take a look at the chart of work. This is one of the trades that we put on last week in the live session. The chart pattern, we were using our pulse indicator, which is the red and yellow histogram down at the bottom. And we talked about how we had a whole slew of yellow bars on the pulse. Those indicate price action being between a 1 and a 2 standard deviation move on the upside. It does not mean price action can't continue to move higher. It just means it's not statistically probable. In most cases, when you start to see at least 3 out of the past 5 bars plot yellow, in many cases, it will lead to a period of consolidation or a reversal in the other direction. Lo and behold, look what's happened since last week. Right here we are, we're at the end of last week, right up at the upper end of the range. I talked to you guys about how we are overbought. I was expecting to move to the downside, and that's exactly what's happened so far. Now, has it been a huge move lower? No. But with the way that we structured our trade last week, we didn't need a big move. If we just stay right here, if we just consolidate and we start to chop sideways, we can make work of that. We can definitely make money with the credit spread that we put on last week. So the trade that we put on, let's go over to the trade tab here. And you will see on my screen the exact position that I put on here last week in that live session. We went and we used the April 17 monthly options. They have 16 days left to expiration. And we came in and we sold the 30 call. We bought the 32 call at the same time. We created a $2 wide call spread. And we collected 75 cents to put that position on. So we collected $75 per spread. That's the most we can make on the position. I talked last week about how the only way that we can make that entire 75 cents is if we hold right up to expiration. That's not something that I want to do. The risk increases the closer we get to expiration. The options become more sensitive to changes in stock price. Instead, we like to target between 50 and 75% of our maximum profit potential. So if you collected 75 cents, I'm looking to close the trade out between 18 and 36 cents. Anywhere inside of that range would be acceptable. So let's take a look at where things are at right now. You can see inside of my platform, we're currently up around $250 or so on the entire position. I put it on with 5 spreads, so it's a pretty small trade. And we're up about $50 today. Here's how we can create a closing order if you have not done so already. I'm going to show it to you here in the Thinkorswim platform. Right on the trade tab, right on the trade page, you'll see down towards the bottom where my position is outlined. I can see the exact position. I'm short 5 30 calls. I'm long 5 32 calls. If I go ahead and hold down the control button on my keyboard, hold down the control button, I'm going to click on both of those options. So they're both highlighted in blue now. Once they're highlighted in blue, I'm going to right click on either one of them. And as I right click, you'll see an option to create a closing order. Right at the top, it gives me the option to buy 5 verticals. That's exactly what I want to do. I sold these spreads to open the position. I want to buy them back to close it out. So I'm going to go ahead and click on buy, and it's going to create an order down at the bottom. Now it's already got my quantity set correct. I'm trading 5 spreads. Now I can change the price. Right now we're trading 30 cents mid price. That does fall inside of my profit window. Again, if we want to close it out and keep 50 to 75% of our max profit, I want to create the order for between 18 and 36 cents. So I can do that right now and book the partial profit if I wanted to. The other option would be to hold a little bit longer. We know the market's been incredibly weak so far today. We've seen a nice sell-off. We need work to stay below $30 a share. As long as it stays below 30, I can make money. The current price of the stock's around 26. So I've got about a $4 cushion here before I'm in trouble. There's a lot to like about this trade still. What I can do, if I wanted to set this closing order for 18 cents, I can go in and change the price from 30 cents to 18. So I set the price to 18 cents. Then I can also change the order type from a day order to a GTC. That stands for good till canceled. That way the order stays in place for the next 16 days until it gets filled at 18 cents or until I manually come in and go ahead and cancel the order or replace the order and adjust the price, right? So I have my order working at 18 cents. I just wanted to point this out. If you wanted to change it and bump it all the way up to 30 cents, which is where the mid price is right now, you could do so and you would book the profit. Right now it's sitting at around a $250 profit on the 5 spread position that we put on last week. So it's a really nice quick trade. They don't typically move this quickly, but when they do, it's great. And I have no issue taking the profit and moving on to the next position. So again, I'm going to keep my order at 18 cents for now. If we start to see market conditions change, as long as we stay between 18 and 36 cents for our closing order, I'm perfectly fine closing out of the trade at any point in time. Okay, so that's how I planned on handling work. We actually got down earlier in the session. The spread was trading for around 21 cents. We actually got to within about 3 cents of getting filled on the closing order. Unfortunately, we are off the lows somewhat, so wasn't able to get filled. But keep in mind, with a credit spread like this, we've got 5 ways of making money on the trade. This is going to be a very forgiving trade. We make money if the stock moves up, down, or sideways. As long as it stays below $30, we're okay. We also make money as time decay adds up. Every day that passes, that helps us. And we make money if volatility decreases. So there is a lot to like about this trade. I don't mind being more patient on a credit spread in many cases because they do have so many ways of making money on the position. So let me go ahead and confirm and send that order. Okay, perfect. So now I've got it in place working at 18 cents, and we'll continue to track that one here over the next few days. If you have any questions on this specific trade, feel free to send me an email, mike@netpicks.com. More than willing to connect and talk through that in more detail. One more thing I want to talk about, because it's come up on support on my side a couple of times this week, people asking about the wide markets. And what that means, when you take a look, we have work up here right now. If we go over, let's just take a look at Google. Switch the symbol to Google. And if we take a look at those same April 17 options, let's just go ahead and take a look at the 1105 call options. I'm just going to highlight them in blue there. Take a look at the bid and ask prices. The bid price is at $51.40. The ask price is at $55.60. There's a $4 difference between the bid and ask prices. And that's what you're seeing in a lot of markets right now. With the volatility so high, there's a lot of uncertainty being priced into this market. And that can often lead to the bid-ask spreads widening out. The difference between the bid and ask prices, it starts to get wider. When that happens, it becomes more difficult to get filled quickly on trades and at good prices. It doesn't mean it can't be done. It just means it takes a little bit of flexibility. Here's what I'm talking about. Let's just say, I'm not telling you this is a valid setup here right now. I'm just going to use this as an example. Let's say you wanted to come in and put on a bullish trade on Google, and you wanted to come in and buy the 1105 calls. If I left click on the ask price, it's going to pop up an order down at the bottom where I am buying the 1105 calls. The full price is the natural price down at the bottom. That's $55.60. You're talking about $5,560 to buy the long call. They're expensive because volatility is so high, not to mention it's an $1,100 stock. Well, if we take a look, the mid price down at the bottom is at $53.50. If you place a market order right now, you're going to be filled at $55.60. You're going to pay the full price. If you instead place your order at the mid price, so you place it at $53.50 instead, if you get filled at that mid price, you're saving yourself $200. $200 per contract just by working your order a bit. Now, you're not guaranteed to get filled at the mid price. That's the downside. If you place the order at the mid price, you're not guaranteed to get filled there. In fact, you're probably not going to get filled there right away. It might take a few minutes. You might have to adjust the price a little bit. If you can't get filled at the mid price, if it's a buy order, if you adjust the price higher, it's going to increase your chances of getting filled. So if I change it from the mid price up to, let's just say we change it up to 54. So I adjust it off the mid price by 50 cents. That's going to increase my chances of getting filled at that price. I am giving up $50, but I'm still saving $150 compared to paying the full price if you use a market order. In this market, when trading options, be very, very cautious using market orders. You can get very bad fill prices, and that can add up in a hurry long term. If you start to take dozens of trades over the next few months, if you're giving up between $50 and $200 on a trade just by using a market order, that adds up in a big way, right? It makes it more difficult for you to be successful long term. I like to start all of my orders. I don't care if it's just an individual long call or long put, or if it's a vertical spread like we talked about on work. I always like to start my orders at the mid price. Doesn't mean I'm going to be filled there. I can always adjust the price, but I'm going to start there because I want to try to get the best price possible. Again, if it's a buy order and you don't get filled at the mid price, adjust the price higher. As you do so, it'll increase your chances of getting filled. If it is a sell order, whether you're selling a position to open or selling a position to close, as you adjust the price lower, it would increase your chances of getting filled. As you move that price lower, just know you do give up some profit potential. So there's trade-offs there. In this market, you've got to be flexible with how you place your orders. Do not use the market orders, use the limit orders, and start your orders at the mid price. If you don't get filled there, start to adjust the prices higher or lower off of the mid price by a few pennies at a time. You don't have to get carried away. You don't have to go from the mid price all the way to the full price immediately. As you can see on Google, I adjusted the price up by 50 or 60 cents. Okay, so as I did that, it's going to increase my chances of getting filled without giving up too much on the trade. All right, as markets start to settle down, which they will over the next few weeks, you'll start to see those bid and ask prices. We've already started to see it a little bit compared to last week, at least. If we take a look over at the NASDAQ ETF, symbol QQQ, this is a market that typically has bid and ask prices between 2 and 3 cents wide. Right now, they're sitting at, in some cases, 8 to 10 cents wide. So they're still a little bit wider than normal, but they are tighter than what we saw last week. And I do expect this market to stay very active here over the next few months. I just don't think we'll see the extremes that we saw the last few weeks. I think it'll be a much more tradable market. We're already seeing that here this week. It's very active, but it's much easier to get in and out of trades at good prices. So again, if you have any questions on where to place orders, what prices should you be using, let me know. Send me an email, mike@netpicks.com, and we can certainly connect and help you through that in a little bit more detail. I think the key to remember here, guys, is as extreme as things have been the last few weeks, this is not going to be the new normal. It's not sustainable to have volatility this high. In fact, this has been one of the longer stretches that we have seen with volatility this high. So it'll get easier here. If you're struggling to get orders filled, if you're struggling with the speed of the market, don't necessarily recreate your system or recreate how you do things, expecting this to be the new normal. Can you adjust in the near term? Yes. Yeah, we can adjust how we place orders like we just talked about, but things will start to settle down. So don't get overwhelmed by markets. I've been trading now for almost 20 years, and it's been a challenge. The last couple of weeks has certainly tested all of the skills that I've tried to develop over the last 20 years. So let's see what happens here to end the week. I will jump back on here towards the end of the week for another recap video. We'll take a closer look at the work trade, and then we'll also talk through a potential new setup going into next week as well. So I'm going to wrap this video up here. If you have any questions, again, mike@netpicks.com is the email address. Enjoy your afternoon, everybody, and we'll talk to you here later in the week.